My name is Andrew Stotts of the Valuation Master Class, and today we have another student presentation. Today's presentation is going to be on the company Chevron. What do you think? Oil and gas, renewables, sustainable, ESG, all kinds of stuff goes on when you hear the word Chevron. But most importantly, the question is it worth buying now? Should you buy it? Should you sell it? What's the situation? Feel free to ask any questions that you may have as we go through this, and let's get started. Hold on. All right. Alima, how are you?
I'm good, Dr. Andrew. How are you?
I'm excited. I'm excited to
Good to hear that.
I'm excited to learn more about Chevron.
Great.
And I know that you got a lot of energy to bring.
Yeah, hopefully. Let's see.
Yes. So I'm going to bring up your screen. So hold on one second.
Okay.
And before we get started, I just want to remind anybody who's watching right now and anybody that's, online watching and anybody that comes across this, feel free to put any questions in the chat and we'll be sure to try to answer those questions either now or in the future. So I think I'm going to exit this and let you take over. So you ready?
Yeah, sure.
All right, I'm going out of the scene. Take over now.
Let's go. Okay, so hello everyone. I'm Alima, and as mentioned, I'm here to share my investment analysis on Chevron. I'm going to start by saying their new investments are excellent, but it would take some time for all of that to play out. So I initiate coverage on Chevron with a sell, and this is based on a target price of US dollar 118, implying a downside of 22%. This comes from a DCF based valuation using a WACC of 10.1% and a terminal growth of 2%. Some of the highlights of the long term optimism despite this sell recommendation are strong revenue growth potential from new upstream and LNG capacity, new investment targets are targeting dependent markets and high margins. They have maintained a strong balance sheet amid cyclical earnings. All of this comes with some risks. Negative impact of oil price volatility on earnings forecast, unexpected supply chain disruptions from geopolitical factors, and multiple litigation issues amid climate concerns and acquisition. We'll talk more about these towards the end of the presentation. Now, let's look at the company background and some recent activity. So, Chevron maintains a market share of 12% in the integrated oil and gas and petroleum refinery sector. It is amongst the top 10 global oil companies with a brand value of around $14 million. Currently, Chevron maintains proved reserves of more than 11 billion barrels of oil equivalent. Most of its upstream exploration is placed in US. 46% of its proved developed oil reserves are present in the US, while most of the natural gas reserves are concentrated outside of the US, mostly in Asia at 32%. Chevron operates under two segments, namely upstream and downstream. International downstream consistently makes the highest share of revenue. Last year, 77% of total revenue came from downstream. 55% of total revenue was generated internationally. Production stands at more than 3 million barrels of oil equivalent per day, out of which more than half was natural gas output. Downstream operates with popular brands of Chevron with Techron and Texaco in US and Europe, and Caltex in Asia and Southern Africa. I expect revenues to increase in the latter years of the forecast period, and we will see why exactly that is the case. If we look at the recent quarters, in the second quarter of 2024, a slight decline in gross margin led to an 11% year-on-year decline in EBIT margin and an even higher year-on-year decline in net profit margin of 26%. Some good news recently was that the Hess acquisition was approved by FTC in the Hess CEO and OPEC case. However, arbitration for the Guyana JV is delayed until the mid of 2025. And recently, in the start of October, Chevron sold around $7 billion worth of Canadian shale acreage in Alberta to Canadian Natural Resources. So now is the more interesting part. Why exactly do we expect long-term optimism despite this sell recommendation? So, Australian Gorgon LNG project produced first output last year, increasing capacity by around 4%. New production from the Gulf Coast, Permian, Duisburg, Guyana, and Kazakhstan would increase oil production capacity by around half of the current daily oil output. As a result, I expect revenues to increase by around 8% at current prices when demand and arbitration result is favorable. The 30% share in Guyanese JV and new acreage in the West Coast Duisburg represent high margin products. Varying stakes in 21 new blocks in West Africa and Brazil increase exploration acreage in dependent markets. For example, Chevron makes a 26% market share in Angola and is among the top 5 upstream players in Mexico. Hence, I expect these investments to lead the sustained margins, these types of investments, and market share internationally. Strong balance sheet maintenance amid cyclical earnings come in the form of repayment of debt, increase in capex, higher dividend payments, and buybacks. Recent quarters present increased buybacks and capex for 2024 as well. I conclude that the fundamentals of the company are stable, and the above factors show prudent preparations for the long term. These are some constraints that could go potentially against the growth drivers that we just discussed. Major rank means it has potential to change the growth direction into the opposite direction, while minor means not really. For capital, I give a minor rank. As an integrated oil and gas company, it is important to maintain upstream earnings cushion through capex, and Chevron does this consistently well with healthy cash flows and less than 40% debt to total capital. For operations and market, I give it a neutral rank. Historically, Chevron maintains stable logistics, targeting competitive areas of oil exploration. However, significant pipeline network and reservoirs extending to areas of war take this rank from minor to neutral. In the case of market, the revenues and pricing are highly sensitive to geopolitical conditions, but an increase would be favorable. So it's kind of like a double edged sword. Recently, there has been a rise in climate change activism. However, as a US based company, this limitation is lower than European peers, and oil demand continues to persist in major economies, as we can see from the OPEC data in the chart here. One potentially major concern for an oil and gas company like Chevron is that the company is highly dependent on high qualified labor for research, exploration, and technological development. And the current CEO and other executives who enjoy high popularity on energy sector platforms currently. Now that we've talked about the fundamentals of the company, let's look at Chevron's market position in the oil and gas sector. So we're using three tools for it, and the first are the five forces presented by Michael Porter. So how we do this is for each force we ask a few questions and we give it a rank from 1 to 5, 5 meaning the best. And that results in a certain percentage score for the overall market position of the company. For Chevron, the overall score is 65%, as you can see here, and the slightest contribution is the lowest contribution is from its position against competitors, and that is 47%. And the highest contribution is against the threat of new entrants. Actually, the discussion of new entrants because there is no such significant threat. In the case of competitors, by revenue and asset base, it is smaller than Exxon and Shell. Overall, oil production has declined globally with limited resources. Global dependency on oil and gas continues, however. So, investments in alternative sources are increasing. This brings higher competition amongst industry participants like Chevron, Exxon, and Shell. In the case of new entrants, being an integrated oil and gas company requires vast professional expertise and huge capital investments, which is not possible for every other new company. Companies which are not fully integrated, like Chevron, have limited control over oil resources. For example, TPL generates revenue on acreage mostly owned by Chevron and Exxon, and Hess acquisition grants Chevron 30% added control in Guyana assets. And so their market presence and reach is comparatively limited as compared to Chevron. Another tool we use for understanding a company's market position is the FEMR. And here we basically compare Chevron against 1,800 non financial companies in the US based on fundamentals, valuation, momentum, and risk. And we can see that the overall rank for Chevron is slightly above neutral. It is highly attractive in terms of valuation because of slight decline in PE and PB recently, and the company maintains high market value because of its strong brand name. And it is also highly attractive on the basis of risk because it is consistently reducing its debt proportions, and low beta suggests low sensitivity to the stock market. The third and the last tool we're using for competitive positioning is for understanding its competitive position is the world-class benchmarking. And here we are comparing Chevron against 280 large energy companies globally in the past 12 months. Both profitability and growth weakened in the past 2 years, as we can see from the ranks of 4 versus 3 and 8 versus 4 here. Asset efficiency and expense control over here in the third layer are the main shields that secure overall growth against volatile revenue trends, because you can see that the trend here is ranks here are around 5 and the ranks here are at 8 and 7. Now let's look at the leadership and ownership structure of the company. So the number of directors on the board are 12, which is higher than the S&P 500 average, and it is a good deal above the requirement of NYSE, which is number of independent directors. The minimum number of independent directors is at least 50%, or we can say majority. And for Chevron, 11 of the directors are independent, other than the chairman. If we look at institutional ownership, it's at a 75%, which is quite higher than the oil and gas company average in the US, and all the overall average in the US of 46%. Let's look at the ESG position of this oil and gas company. For ESG, the overall score is 53%, and it's obvious that it's coming down because of the 20% score in environmental, as we would expect for an oil and gas company. Initiatives for efficient utilization of fossil fuel assets are in place, along with usage of renewable fuels in operations. One example is replacement of diesel as a primary fuel in Permian drilling. However, investments into oil and gas and addition of new exploration sites continue. If we look at this social point of view, it scores at 80%, mainly because of its strong safety and human rights policy and a well established quality management system, which they call the Operational Excellence Management System. For governance, the score is 60%, and it mainly comes down because of the fact that the chairman and the CEO are a single person. Um, al- Although the proportion of independent directors is is high enough at 92%, and there is a stable corporate governance policy, and there is a good level of transparency through their good quality sustainability reports and lobbying and trade associations report. So this was all about the company. Now that we understand the company better, let's look at how all of this comes on to the financial statements. So in short, the revenue is going to increase from 2025 onwards, and so is the profit after some dip in 2024. That's going to result in higher capex and higher dividend payments, along with increase in assets and slightly lower on average cash reserve levels for the forecast period. Higher sales are going to bring in some higher level of accounts receivable, and higher production is going to bring in some higher level of inventory. As a result, some years of negative working capital. And overall, if we look at the very bottom line of this, the average free cash flow per share is going to be slightly lower than the recent past average. Now, let's look at the relative valuation. Uh, the EPS growth in 2024 is assumed to be negative. So I use a 2025 estimate of PE to EPS growth for relative valuation. This suggests Chevron is highly expensive compared to the energy sector in the US, and it's quite obvious from the chart. It's also highly expensive as compared to its global peers and Asian peers. I forecast the return on equity to be around 14%, as we can see here, higher than the sector average in Asia, but much lower than the global and US sector average. This results in Chevron trading at a premium from global and Asian peers and a similar position to the US sector. Quite obvious from the chart again. And this table summarizes the assumptions that I took for the absolute valuation. So I'm taking a risk-free rate of 2%, a market equity risk premium of 10%, An average beta stock, this is how Chevron has performed recently. So I take a beta of 1, a WACC and a discount rate of 10.1%, and the free cash flow to firm metric to value Chevron. In the base case scenario, the average sale across the forecast period is 5.2%, and it results in a target price of US dollars 118. In the optimistic case, it assumes a sales growth of average 5.7%, and in the pessimistic case, a sales growth of 4.7%. And this increases the target price to a max of US dollar 120 and a minimum of US dollar 160. Now let's look at some of the risks to Chevron, associated with Chevron. The negative impact of oil price volatility on earnings forecast. So Chevron's earnings are highly sensitive to volatile oil prices, as we can clearly see from this chart. My forecast assumes a rebound of the oil market in 2 to 3 years' time, but if the trend is opposite or lacking recovery, the earnings will be worse off. The second important risk is related to the supply chain. Some of its subsidiaries and joint ventures are in the Middle Eastern areas of extreme political disturbance. This recently had upset a significant production opportunity. In addition to affecting the price, this can affect pipeline networks, trade routes, and storage capacities. Around 45% of its natural gas reserves come from Asia, Africa, and Kazakhstan. The third point to notice here are the litigation issues. It is not a new event for an oil and gas company like Chevron. The costs of such events have been historically low, but they can impact the company's operations and related expectations. So, this is something we should consider. Alright, I'm done with my presentation here and I'm open to Q&A now.
Excellent. Okay, let's go to your free cash flows so we can look at
Sure.
your forecast there. So in the free cash flow, what I
Yes.
saw was a very heavy load of capex that you've got. Particularly, we see it really kicking in 2025, 2026,
Yes.
compared to the past where it was 6 billion, 9 billion, 15 billion.
Mhm.
Tell me a little bit about why you're forecasting such a high amount of capex.
Alright. So, like I said in one of my stories, that it seems like the company is taking on multiple new investments and addition of new exploration sites and new production acreage is definitely going to require some capex for production to actually come out of there. And the targets that we're seeing for 2024 and the way that the management is presenting guidance, it seems like this trend is going to continue and be on an increasing trend for years to come.
And if we were to assume, let's just assume that I'm looking at this company and I think, well, I'm going to knock down that capex a bit.
Hmm.
Let's say, would that change? Would that change your? To what extent would it change your target price? And your expectation and your opinion about the company. As an investment.
Right. Okay, so the target price that we have right now is around 118, right? And it is at a significant lower level than the stock price. So I could lower down the capex, and maybe if we revise this valuation, we would say, all right, maybe we don't expect this high level of production. Maybe the demand levels change, and then we say the company would not be taking on so much of an increase in capex. But that would still have cash flows max at a max. It would go to the level that it is in the past, and it's not much different from the levels that we're forecasting. And
Okay.
that again, the price that the free cash flow is offering is going to be lower than the stock price because I don't accept. It's going to take some time for all of this to actually flow into the free cash flow so that it builds into the target price.
So, one of the questions coming in, this one from Zishan, who says, "What to what extent would that change your opinion from sell to buy, or is there anything else that would make you a buyer if something changed?"
Right. Okay, so one thing's for sure that I am optimistic about the company, right? But simply put forward, I would say that in the near term, the outlook that the company is presenting, it looks like there's going to be more outflows than inflows. And all of the good news that we've been talking about, that is going to result in some that is going to result in increased capex, that is going to result in increased dividend payouts, and so there's going to be more outflows, and so there's going to be lesser free cash flow available to bring the target price up. In the case of Chevron, it looks like all of this production is going to come on board later on and then eventually flow on into the bottom line of the income statement or even the top line. That is already being priced in by investors, and they're keeping the price at that level.
Okay.
You know, yeah.
Um, Yash asked, what's the reason behind the terminal growth rate of 2 instead of, let's say, 3 or some other?
Well, I would say Chevron is a mature company. It is placed in a mature sector, and recently it would be wrong to say that it all depends on the climate activism and that oil and gas demand is going to reach its peak, but there is a gradual decline overall in the recent years in the oil demand, and until or unless that recovers, I don't think it would be reasonable to go above a 2%, which is average GDP growth for a country like US, for the terminal growth rate.
And how significant some of the energy companies are trying to transition to what they call sustainable fuels. And I didn't see you talk much about them, let's say, trying to do wind or solar or something else. Where did they stand, with this whole issue?
Well, I would say they have a whole sustainability report as per the requirement, and there are multiple initiatives that they mention. Somewhere they are replacing the fuel that they're using in operations, somewhere they are producing new renewable output. But if you compare the quantities to the quantities of the oil and gas products that they're making, the upstream sector, and they keep adding new exploration sites to the upstream business. And so it looks like they are going to continue tilting towards the upstream and traditional fossil fuel business. And together with it, as much as possible, they would be adding some or the other new investment with, for renewables and alternative fuel sources. But the focus is going to be oil and gas and traditional fossil fuel. This
Would
is
you
what I
say
would
that
say.
it's the American oil and gas companies that aren't going as strong down the sustainability route compared to European, or what is your idea on the industry?
Okay. Well, there is difference, a huge difference between how people are pricing American oil and gas companies and how people are pricing other oil and gas companies. For example, I worked on Shell before, and I was saying the same thing, that people don't give Shell the price that they give to Chevron. It's a much bigger company. There's much more diversity in their operations, but the price for Shell is far below the price that the people are willing to pay for Chevron. And so I think there is difference in how the investor community is perceiving the whole sustainability picture and ESG picture. And as a US based company, Chevron and other US companies have an advantage in that scenario.
Warren Buffett bought this stock a while ago. I can't remember when he, entered. Do you know anything about when he entered into Chevron?
I think the first entrance was in 2020,
And
and
then
there have been some and it keeps changing, some buy and some sell, but the first entrance was in 2020, if I'm
can you
not
go
sure.
back to your first page?
Yeah, sure.
Okay. So I see that the price was up to 190 and now it's down to 150. If Warren Buffett was willing to pay, you know, whatever that price was in the past,
Mhm.
aren't you tempted to say it's a buy at this point?
Okay. So I think I really need to explain the point behind the target price.
Mm,
They are going to increase their production by
yep.
some levels, but the way that these companies and governments are increasing production, demand is not increasing as much. Production is definitely increasing much faster than demand. That's one
Mm.
thing. The second point here is that multiple new exploration sites have been added. They're going to require some capex. They're going to require some outflows. Secondly, the if we're talking about this, right, and then we look at how this is building into the cash flows. In fact, if you look at the story and we look at the, let's start with the Guyanese assets, right? They're the spotlight of the story these days. Now, the deal is delayed until the mid of 2025. Even if it goes until the third quarter of 2025, it's going to take some time for all of this production to actually come on board and bring in something, flow in something into the bottom line or even the top line of the income statement. So
Okay.
until or
So
unless that comes into the picture, the target price cannot be maintained. It is hard for the stock price to be until we have a clear picture on all of these factors. It is hard for the share price to consistently remain at this high level.
so what you're saying is maybe it's time to just wait, and when we see that cash flow coming in, then we start to turn more positive. Can you go to your last page, the risk page?
Sure.
I was curious about the graph there, or the map.
Mhm.
Tell me about what that map is showing us.
Okay. So one point that you need to focus on right now, since we're talking about Chevron, is the area that is a track that goes from the US to this area.
Hmm.
And what I'm trying to point out is that there is a region in the middle that is quite susceptible to the war situation in the Middle East right now and the attacks that are going on. Recently, a production opportunity, there was a level of production that was going to be achieved, but then it was halted, and that was because of an attack on an area, on a production area of Chevron, and it was a significant opportunity. So, what I'm trying to show by this chart is that the network, right, as a US based company, is going through a sensitive position, and
Hmm.
we need to consider that because of physical supply chain risks, and they are significant.
Do you know how much how much China consumes? Did they sell? How much do they sell to China? Is it 5% of their total revenue? Is it 30%, or is it zero? Just curious.
Right. So, like I showed here in my graph, let me just go back there. We have around 55% of revenue coming from our international regions.
Hmm.
And the reserves of natural gas are concentrated in Asia, and also the sales are concentrated in Asia when it comes to natural gas. And so, a major contribution would be China within that proportion, whatever that is exactly.
Okay. 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 Hold on one second. You can escape on that, and then come in and let's talk for a couple minutes.
Sure.
Can you see me?
Yes, I can.
So how does it feel to graduate from the Valuation Master Class?
Um, it feels great, but I'll be honest, it has opened my eyes to uh, many more things, and I feel like I still have a lot more to do now. Yeah,
Well,
a bit more than the boot camp. I'm less confident than the boot camp now,
yeah,
in a positive sense.
exactly. Um, how would you describe the transformation if you think about day one compared to today? What's the difference about yourself? What is it?
The difference about myself is, like I mentioned, I've realized that there's like quite a lot more to do, and I've started taking a lot of interest in the oil and gas sector, and so I chose Chevron again. So it kind of opens your eyes that there's a lot out there. It's more than just the annual report. It's more than just the model that you're staring at, and it's very hard to actually say something in the practical world and make a claim in the practical world. That's what I can say right now.
Mm. And what would you say to a young person who's looking at attending Valuation Masterclass? I mean, it's a lot of work for sure, right?
Yeah, definitely.
They're looking at it. They're not sure if it's worth it. What would you say?
I would say join in and give it a try. I mean, you can go until the boot camp. You don't necessarily have to come to the professional. The boot camp gives you a good idea of whether your team is good, whether you're this is something that you're interested in. Because when the work increases in research and all of this, for some people they realize this is not the kind of thing we want to do, because they're just a different type of personality. So I would say give it a try. I mean, there's no
Mm,
loss in that.
yep. And what is your thoughts about your future now? I mean, how do you look at your what you want to do, for career and all that, compared to how you were looking at that when you first went into the boot camp?
Um, I think it's early to say, but definitely something around the lines of financial services, because I feel like this is something I'm passionate about. But I don't have a clear roadmap. Um, Going to focus better on, as I learned from the team and members of the team here at VMC as well. It's better to focus on what you have right now and to improve it as much as you can, and then it clearly, gives you an idea of where you want to go. So that's what I'm going to do.
Fantastic. All right. Well, congratulations. That was a great
Thank
job.
you.
And I'm going to take you out of this, and then I'll come back and talk to you in a second. So just hang on. Hold on.
Thank you.
Well, that was amazing and a great breakdown on Chevron, and gives you something to think about. It's interesting how they're really focused on oil and gas, and they're less caught up in the concept of sustainability or developing solar farms or things like that. Whether that's right or wrong, not sure. But the point is that uh, the company has a global footprint and is a pretty significant player. Obviously, I know in Thailand, Chevron has gas fields together with Thai government related companies, and those gas fields power Asia. So it was a great one. And if you want to build a competitive advantage in company valuation, well, then join us in the next valuation masterclass. Just go to valuationmasterclass.com